Whether you're investing to build up your retirement savings or maybe saving for a child's education or for a big purchase like a home, the idea is simple. You invest your money with the idea that it's going to grow and help you reach your goals. But what happens if your investments don't grow as expected and you're left wondering how you're going to meet your investment objectives? While it's obviously important to know good investing strategies, it's also important to avoid making big mistakes. So in this video, we've put together a list of the 7 most common mistakes we see people make when it comes to investing. We've identified how to spot them and tips and tricks for avoiding them. Mistake number 1 is failing to diversify your portfolio. Diversification is one of the best ways to ensure you get return and risk mitigation in a variety of different market conditions. Diversification is a strategy that involves including a lot of different types of investments into your portfolio. Sometimes investors think that the best way to get really high returns is to go very heavy on one particular stock or sector. Now, this might work for the short term, but overall, if the market is to move against that particular stock or sector, it can be very disastrous for your portfolio returns. A well-diversified portfolio may have holdings in different asset types, so stocks, bonds, gold, commodities, or even liquid alternatives. It would include different types of geographies. So we might see investments in Canada, the US, and internationally. And then finally, it'll also be diversified by market cap. So small, large, and mid-cap size companies. While having a diversified portfolio doesn't necessarily mean that you're going to have complete protection against the downside, it does help ensure that when certain parts of the portfolio are doing poorly, there will be other types of the portfolio that are staying afloat. Ideally, there should be some part of your portfolio that is always doing well. The advantage, of course, is that you will lose less during major market corrections like the tech bubble we saw in the year 2000 or even the Great Recession that we saw in 2008. Mistake number 2 is trying to time the market. Successfully timing the market is extremely difficult. Even big institutional investors fail to get it right sometimes. And in a lot of instances, trying to time the market may actually hinder your investment returns. In a well-known study, on average, 94% of the variations of returns of an investment portfolio over time was explained by the investment policy decision. In other words, most of a portfolio's returns can actually be explained by asset allocation as opposed to when you entered the market and also on security selection of different types of assets. In the process of trying to time the markets, a lot of investors will lose out on profits because they either wait too long to enter or they wait too long to exit. Mistake number 3 is having unclear financial goals. By having clear set goals, you'll know how much money you need to fund those goals in the future. Once you know how much you need, you can then figure out what returns you need and therefore what level of risk is appropriate. Mistake number 4 is following bad advice in the media, social media included. For example, you may feel compelled by some influencer on the internet to start investing in a particular stock or fund. But this person doesn't know your financial situation at all or what other investment vehicles you may have available to you. For example, they might not know that you have a generous employer savings plan that matches some of your contributions. So that might actually be a better avenue for you versus investing in this, particular stock that someone has recommended. At the end of the day, only you and your financial advisor will know how adding new investments or removing investments will ultimately change the probability of you reaching your financial goals. Mistake number 5, diversifying your portfolio. In mistake number 1, we talked about the importance of diversifying your portfolio. And yes, while it is really important and it does really help with risk-adjusted returns, it's equally important to consider not overly diversifying, or in other words, diversifying your portfolio. Diversifying your portfolio is the process of adding more and more investments into your portfolio without considering how they're correlated to the investments that you already hold. An example of diversification may be adding a few US stocks to an already heavy US equity mutual fund portfolio. In this instance, you may want to consider adding things like gold or commodities or real estate, assets that tend to have a lower or negative correlation to US equities. A slow and steady approach to portfolio growth can yield the greatest results over time. If you're a marathon runner, you're not going to measure your time in 50-meter increments. The same can be said for long-term investing, especially for things like retirement accounts that tend to have the longest time horizons. A common mistake that investors make is being impatient with portfolio returns. They expect an unrealistic return over a short period of time. Expecting a portfolio to do something other than what it was designed to do can be a recipe for disaster. Impatience is often the killer of many wise investments. Not waiting out a downturn and selling out of a particular mutual fund or stock right at the bottom of the market, assuming that that particular investment has seen its best days, may be a regret later on, especially when it's an investment that has been known to do really well over the longer term. While it's easier than ever to get instant information on your portfolio returns, it doesn't mean find that it's necessary to be checking all the time. It's really important to keep your long-term growth and your return expectations aligned with your time horizons. You may wind up adding assets that have similar correlations to the investments you already hold, and therefore you're really just taking on more risk without getting any added return. To help prevent diversification, before adding a new holding to an existing investment portfolio, we recommend that you take a look at what you're already holding. Take a look under the layers if you're holding things like ETFs or mutual funds to see what those underlying holdings are. And you might find out that the stock you're adding, you already have a huge exposure to through your ETFs and mutual funds, for example. Viewing negative performance without context can lead to rash decision making. Mistake number 7, individual stock picking and not focusing on asset allocation. Multiple research studies will agree that over 90% of the variation of a portfolio is attributed to asset allocation, not necessarily individual stock selection. While establishing an appropriate asset allocation is a dynamic process and will change over time, choosing the correct asset allocation is going to have a big impact on how your investments grow over time. It helps to ensure that you have a balanced portfolio that is well diversified, the benefits of which we have mentioned already. So if any of these mistakes sound familiar, it might be time to review your portfolio to make sure it still makes sense for the goals you want to achieve. Our team at Ferguson Financial Planning would be pleased to provide you with a complimentary second opinion on your portfolio, and you can schedule a time with us using the link below in our description. If you liked the information in this video, be sure to check out our website and also be sure to like and subscribe or leave a comment. Thank you for watching.